But importantly, when it comes to real estate, as Sam said, we are seeing some green shoots, but it's still a very weak market. So I would be very cautious on the next 3 to 6 months on housing prices in China. People, even though they're happy like I am, they just don't want to spend on big ticket items. So like housing prices in my housing compound in Shanghai have dropped 7 to 20% over the last 6 months or so. And the real reason, Will, aside from confidence, is it comes down to credibility. The Chinese government gets all of its credibility by having a strong economy. At the end of the day, if the economy is not weak, is not strong, and it's too weak, the government loses its legitimacy. Because the economy is so weak right now, it's losing its legitimacy, and people are scared about buying big ticket items like homes. I would be cautious over the next 3 to 6 months, frankly.
Just the next 3 to 6 months, because I completely take your point, and obviously you're going to get a little bit of an upshoot on just a general consumption basis because of the increased mobility. But there are a lot of people that are trying to make this assumption that consumption is going to be the domestic demand, is going to be the real growth driver. Buy all the China tech stocks now because they're incredibly cheap. But when you look through the data and you look at I suppose, spending intentions, when you look at, the difference between how Chinese save and how some of the other Western nations save, because everyone always looks at the savings rate, do you come to the same conclusion, or are you thinking that perhaps people need to calm down a little bit and just allow for this gradual recovery to take place, and it's not going to be anything we see until perhaps 2024 maybe?
Yeah, that's a great question, Will. I actually disagree with most of the analysts. My team has traveled to almost half of China's provinces in the last 6 months. Consumer confidence is down. So you see huge savings numbers, 2.9 trillion, 3 trillion US dollars are a lot of the estimates. But people are saving for a rainy day. Even though you're seeing the economy is getting better in January and February, people are wondering, is this economy going to continue this momentum? Was the real weakness over the last 3 years because of COVID and zero COVID policies, or is it more because of U.S.-China relations? And I think the backdrop of geopolitics is something that everyday Chinese are thinking about and saying, you know what, maybe we shouldn't go out and spend that much because we have to save for a rainy day. Now, they'll indulge themselves a little bit, so they're going to go out on travel trips. Domestic Chinese tourism was pretty strong during Chinese New Year. You went to Hainan, you did China duty-free shopping, so I'm fairly bullish on like Trip.com as well as Meituan and some of the hotel chains like Hyatt and Marriott, because people are spending on travel and leisure after being cooped up for so many years. People are just not buying the real estate. So I think you're going to see in the short term some bounce up on maybe the metals like a nickel and a copper and Australian iron ore, and maybe you'll see the Aussie dollar will go up a little bit. But again, it's a real short-term bump up because there just isn't demand for real estate. I'd be cautious holding longer than 6 to 9 months, frankly. The demand isn't there.